The income statement, also known as the profit and loss statement, is one of the three main financial statements used to evaluate a company's financial health. The income statement provides a summary of a company's revenue, expenses, and net income over a specific period. In this video, we will discuss the importance of the income statement, its components, and how it is used by investors, creditors, and other stakeholders. Importance of the income statement. The income statement is important for several reasons. Firstly, it provides an overview of a company's revenue and expenses, which are the primary determinants of a company's profitability. Secondly, the income statement is used to calculate key financial ratios, such as the gross margin ratio and the net profit margin ratio, which provide insight into a company's profitability and efficiency. Finally, the income statement is used by investors and creditors to evaluate a company's financial health and growth potential. Components of the income statement. The income statement is divided into two parts: revenue and expenses. Revenue represents the amount of money earned by the company from its operations, while expenses represent the costs incurred by the company to generate revenue. The difference between revenue and expenses is the net income. Revenue includes all income earned by the company from its operations, such as sales revenue, interest income, and rental income. It is essential to note that revenue does not include any non-operating income, such as gains from the sale of assets or investments. Expenses include all costs incurred by the company to generate revenue, such as the cost of goods sold, operating expenses, and interest expenses. The cost of goods sold represents the direct costs associated with producing or delivering a product or service. Operating expenses include expenses such as salaries, rent, and utilities, while interest expenses represent the interest paid on debt. Net income is the difference between revenue and expenses. It represents the amount of money that the company has earned or lost over a specific period. A positive net income indicates that the company has earned a profit, while a negative net income indicates that the company has incurred a loss. How the income statement is used. The income statement is used by investors, creditors, and other stakeholders to evaluate a company's financial health and growth potential. Investors use the income statement to evaluate a company's profitability and growth potential. They also use the income statement to calculate key financial ratios, such as the price-to-earnings ratio and the return on equity ratio, which provide insight into a company's financial performance. Creditors use the income statement to evaluate a company's ability to pay its debts. They also use the income statement to calculate key financial ratios, such as the debt-to-equity ratio and the interest coverage ratio, which provide insight into a company's ability to meet its financial obligations. The income statement is an essential tool for evaluating a company's financial health and profitability. It provides a summary of a company's revenue, expenses, and net income over a specific period, and is used by investors, creditors, and other stakeholders to make informed decisions about investing, lending, and other financial activities. By understanding the components of the income statement and its importance, investors and creditors can make informed decisions about the financial health of a company.